The market slid lower in the latest session, but energy surged 1.8% as aggressive defensive rotation drained capital straight out of tech. Direxion Semi Bear 3X ETF jumped 15.2%. Its moat scores none out of 100. Data not available. Triple leveraged inverse exposure magnified downside across leading chipmakers following tightening export controls on advanced lithography equipment. This daily rebalancing mechanism converts sector volatility into intense leverage as hardware margins compress. Our teardown unpacks how structural regulatory friction fuels this product. SOXS surged 15.2% to $44.19 as semiconductor valuations hit an immediate wall. This vehicle is engineered as a daily 3x inverse play on the SMH benchmark. That means it amplifies daily semiconductor drops by a factor of 3. However, holding this instrument across multiple sessions triggers severe volatility decay. Compounding math steadily erodes principal when markets chop sideways. This structural drag explains why SOXS has collapsed 91.2% year-to-date despite occasional explosive daily spikes. Underlying move comes directly from extreme concentration in the semiconductor supply chain. NVIDIA carries a massive 20.8% weight in the reference basket. Any margin pressure or capex hesitation from hyperscalers hammers its massive multiple immediately. TSM holds 9.6% of the underlying exposure. Advanced packaging bottlenecks and escalating geopolitical cross-strait tensions cap its near-term foundry upside. Broadcom represents 6.6% of the basket. Custom ASIC development costs and enterprise networking cycles are demanding massive capital expenditures. Meanwhile, next-generation memory architectures showcased across the industry require aggressive fab retooling that strains free cash flow. When these three names stumble, they drag down over 37% of the entire reference index. For SOXS, that concentrated drop creates an aggressive triple-leveraged surge. But the combined exposure concentrates extreme single-stock risk into an instrument burdened by daily reset decay. Open the hood on SOXS. The largest single dragging, MU at -7.0%, carrying 5.2% of the fund. SOXS operates without reported AUM or expense ratio data in our tracking system. Yet its structural design reveals severe mechanical friction. The numbers tell a brutal story. A 91.2% loss year-to-date alongside a 3-year average decline of 87.6%. This chronic underperformance stems directly from daily leverage resets in a trending semiconductor bull market. The fund's underlying architecture is heavily top-weighted. The top 5 holdings represent 48% of the entire basket. NVIDIA at 20.8%, TSM at 9.6%, Broadcom at 6.6%, AMD at 5.7%, and MU at 5.2%. Marketing materials might pitch broad industry hedging, but this is pure mega-cap concentration. You are essentially shorting 5 hardware giants rather than the broader silicon economy. Legacy analog and automotive chip makers barely register against the overwhelming weight of compute silicon. Over the past month, baseline benchmark SMH fell 2.5%, allowing SOXS to outperform that direct peer baseline by 0.4 percentage points. That modest relative gain fails to offset the structural erosion baked into the vehicle. Macro conditions, including a 3.63% Fed rate and 0.6% CPI, continue to drive rapid capital rotation across tech sectors. When market direction reverses, the mathematical decay inside a 3x inverse fund accelerates rapidly against holders. SOXS functions as a high-friction tactical instrument whose extreme concentration contradicts any claim of diversified sector hedging. SOXS is trading at a 9.85% premium to NAV. Retail is paying up for downside leverage while institutions are sitting it out. The 5-day to 20-day volume ratio is 0.90x, neutral. That tells us no sustained institutional inflow or outflow. This is purely a retail squeeze on a 3x short semiconductor ETF that's already down 91% year-to-date. RSI at 22.9 and price below both the 20-day and 50-day moving averages confirms momentum is still pointed south, but the premium says the crowd hasn't gotten the memo yet. Direxion markets SOXS as a trading instrument, not a long-term hedge. That's PR code for "this resets daily, fees eat you alive, and compounding will destroy you." The fund's narrative is built on the idea that you can time semiconductor downturns. Problem: semiconductors are now a geopolitical football. Trump's tariff playbook just turned copper into a real-time proxy for trade war escalation. Canada's vow to retaliate locks in policy uncertainty for the next 18 months. Every time a new tariff drops, SOXS spikes on retail panic, then collapses when the actual supply chain doesn't break. That's not a semiconductor cycle. That's a narrative feedback loop. The lab's verdict: SOXS is a structural short volatility trap dressed as a bear fund. The premium is retail FOMO, the volume is institutional indifference, and the macro backdrop is policy whiplash, not fundamentals. Trade the narrative, but know the reset mechanics will erase you before the next tariff headline hits. Before the verdict on SOXS, the engineer's warning: 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but SOXS at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The structural case for inverse semiconductor exposure rests entirely on accelerating macro and regulatory friction. Strict United States export controls on advanced artificial intelligence silicon directly restrict revenue pipelines into China. Because NVIDIA and TSM alone command 30.4% of the underlying basket, targeted trade restrictions immediately depress megacap chip revenues. That concentration delivers a sharp daily mechanical lift to this inverse structure. Conversely, the destructive risk to this fund structure is aggressive compounding decay during extended hardware expansion cycles. Sustained enterprise capex spending on next-generation accelerators overrides short-term export friction, driving underlying equity benchmarks higher and triggering catastrophic triple-leveraged erosion. The fund's 91.2% year-to-date loss proves how rapidly sustained upside in reference assets destroys inverse capital. Moving forward, the lab monitors 2 critical structural indicators. First, track concentration shifts within the top 2 holdings, where any further weight expansion intensifies single-stock delivery risk. Second, monitor daily NAV tracking error during heightened volatility sessions to measure internal execution drag. Market sentiment sits at a fear reading of 41, while the technical RSI registers an oversold 22.9. The lab assigns SOXS an AI ETF score of none out of 100, reflecting pure structural degradation over extended holding horizons. Holding concentration remains the single decisive metric governing this fund's operational viability. SOXS just flashed a liquidity warning mainstream analysts are ignoring. Which metric would most change your business thesis on SOXS? Comment below. This isn't financial advice, just engineering-level data. Markets move fast, and past performance never guarantees future returns. Always run your own numbers before trading. We're here to break down the hardware, not sell you a position. Subscribe so you don't miss Tuesday's deep dive. We're tearing down SK Hynix. The lab's verdict stands.